Let's dig into the FIT 21 situation. Can you explain kind of what
Yeah.
that is for our audience and kind of how it affects the marketplace?
Yeah. So, we're expecting that the FIT 21 Act will be prioritized in 2025 as well. It introduces significant regulatory changes and basically splits oversight between the SEC and the CFTC. So, digital commodities like Bitcoin, which has already been established, are regulated by the CFTC. And then the FIT Act introduces restricted digital assets. So basically, tokens resembling securities would be regulated by the SEC. So, what this means for RIAs managing private funds is they have to identify the classification of each digital asset in their portfolio and comply with the relevant regulatory regime. So, the act has this concept of decentralization certification, which basically means digital assets have to be submitted to the SEC for certification as sufficiently decentralized to qualify as a commodity. And so, therefore, if the SEC certifies an asset as decentralized, it moves to CFTC oversight as opposed to SEC oversight. So, this just means that compliance programs are really going to have to adapt and track and respond to the changes in an asset's regulatory status, which could affect custody, reporting, marketing, disclosures, et cetera. So all that kind of stuff. So that's a really big concept of FIT 21. And then some other areas that it will impact in terms of regulation is it expands anti-money laundering requirements. So there's enhanced transaction monitoring requirements for fund activities like client onboarding and digital asset transfers, uh, similar to what advisors already have to do now, but they should be conducting due diligence on custodians, administrators, platforms, et cetera, to ensure that those other third parties are complying with Banking Secrecy Act obligations. So that's something to keep in mind too, especially in light of the new anti-money laundering rule that's going to be effective as of January 2026. This is an extra layer for crypto advisors that requires consideration. FIT 21 also introduces more detailed custody requirements. So uh, more enhanced transparency around custodial arrangements, stricter segregation of client assets. Interestingly, it also requires that advisors using self custody solutions or non qualified custodians to disclose these arrangements clearly to investors and justify why they are appropriate, because again the qualified custodian with the big Q is the preference for custody arrangement. So if you're kind of not using a qualified custodian, that has to be articulated in policies and procedures and justified a bit.